Hi, you're all very welcome. We probably have some more people joining us. We've just hit 1 o'clock, but you're very welcome to join us today. And my name is Patrick King, the Director of Membership and Public Affairs of the Society of Chartered Surveyors Ireland. And you're joining us for our final installment of our series on as part of the property handbook launch, and this series associated with that launch. This is the final section of that document, and it's going to be it's probably one of the largest sections in particular. We've created this CPD series to accompany the handbook, as I mentioned, and that will be distributed to all attendees in the coming weeks. So this is a bit of a taster and what to expect and what you'll be able to get from the document. So over the past 2 weeks, we've been running these lunchtime CPDs focused on a number of different topics. And today's session will be broadly focused on the area of tax. Again, we're not trying to aim for members to become tax experts or to be giving tax advice. You obviously want to stay away from necessarily giving that. But what you can do is allow this session and the handbook will allow you to give clients a bit of information about what they need to be aware of in terms of issues that could arise in terms of tax liabilities, but also maybe opportunities that are available to them through in dealing with property. Our speaker today is Donal O'Dwyer from the FDC Group. They work in terms of advising rural Ireland across a wide base of farmers, SMEs, family businesses, commercial agribusiness, and self-employed professionals and contractors. So really, I think Donal is well placed to answer any questions that may arise. I want to just really encourage you as you join us today to make use of the Q&A function to ask any question that may pop up. We'll be covering a very high level, a whistle-stop tour of all of the tax items. So if there's something that you want to come back to, just ask something in the Q&A as we go, and we'll come back to it at the end of the session. So without further ado, I'd just like to thank Donal and hand it over to you. Thank you.
Thanks, Patrick. Good afternoon, everyone. Donal O'Dwyer is my name, as Patrick said, and I'm with the FDC Group. I work in the tax department group company, and as Patrick said, we deal a lot with farming clients, and we have offices all over Ireland. I suppose myself, I deal primarily with capital taxes, farm transfers, business transfers, and of course transfers of property. So today I've prepared a shortish enough presentation just to take you through some of the tax aspects that pertain to property transfers. So I suppose at the end any questions that you have, we can deal with them at the end. So I'm going to start off with stamp duty. So stamp duty arises on any stampable document, which would include deeds of transfer. So stamp duty is the concern of the purchaser. The purchaser must pay the stamp duty. And the rates are different for residential property and commercial property. So residential property, as you can see, the rate is 1% up to €1 million and 2% on the margin over 1 million. And commercial property, which would include farmland, is at 7.5%. So that's up from 2% 3 or 4 years ago. So commercial property is at quite a high rate at the moment, since October 19. Some of the reliefs there, the first one I'll talk about is the refund that you get where a person might purchase commercial property and build a residential property. So a refund will be due if the taxpayer, constructs a residential property or commences construction within 30 months of the stamping of the document. That person can apply to revenue then to get a refund of 6.5% of the 7.5% that would have been paid on site. Another relief, consanguinity relief, is quite common in practice. When the stamp duty rate went from 2% to 6% and subsequently to 7.5%, consanguinity relief, the availability of consanguinity relief was widened. Previously, it was only available where the transferor was aged between, I can't remember exactly what the ages were, but it was quite a restrictive relief, but it was opened up when the commercial rate for stamp duty increased to 7.5%. So now, any transfer within the family, so from parents to children, from grandparents to children, from uncles or aunts to nieces or nephews of farmland only, there's a 1% stamp duty rate. When that rate is claimed, the beneficiary, the person receiving the land, either by way of gift or purchase, must actively farm the land themselves or lease the land to an active farmer for a period of 6 years to avoid clawback of the stamp duty relief. So that's quite common in practice, consanguinity relief. The young trained farmer exemption, so it applies to farmers under 35 years of age who are qualified or trained, which means they would have an appropriate qualification, a green cert, or etc. There's a list in the legislation of relevant qualifications. So the taxpayer must, or the person claiming the relief must submit a business plan to Teagasc, and if Teagasc are satisfied with the business plan, they will issue a certificate, and the solicitor can then use that certificate to claim the exemption when the deed is being stamped. So it applies to farmland and farmhouses. However, the land must be farmed after a transfer, unlike consanguinity relief and agricultural relief we'll talk about later on. But there's no option to lease the land when the young trained farmer exemption is claimed. It's aimed at active farmers. So in 2021, in this year, there was a lot of controversy over investors, funds coming into Ireland and block purchasing entire housing estates in the context of housing crisis here in Ireland. So a proposal has been put forward by the government to bring in a 10% stamp duty rate where 10 or more houses are purchased by one individual or company, I believe, in any 12-month period. So that's aimed at preventing institutional investors getting involved in purchasing residential property. So that's going through the Oireachtas at the moment. So leases of land, again, a stampable document giving rise to stamp duty. The rate depends on the term of the lease. So as you can see there, less than 35 years, 1% of the average annual rent. Greater than 35 years, less than 100 years, 6% of annual rent. And if the term is greater than 100 years, it's 12% of the annual rent. Since about 2019, I think there has been an exemption from stamp duty on certain leases of farmland. So farmland leases are generally exempt from stamp duty. So capital gains tax. So capital gains tax is the concern of the person disposing of the property, selling the property, or gifting the property. The rate is 33%, and it's 33% of the uplift in value of the property between the time that the person purchased or acquired the property and the date of sale. So first thing I would do if I realized somebody had a capital gain, I would try to determine whether that person has incurred any capital losses in the past. So that could be losses on the sale of property, on shares, if businesses that had become negligible value, so forth. So if capital losses have been incurred prior to or in the same year as the gain accrues, well then that loss can be offset against the gain. So that's losses. when you calculate the capital gain, you can make certain deductions to bring down the tax bill. So the common ones are the associated costs of sales and purchase, which would include the solicitors, auctioneers, any accountancy fees, stamp duty, and advertising costs. All those costs can be deducted to bring the gain down. Enhancement expenditure. Enhancement expenditure is the sort of expenditure that would be capital in nature, that would have been incurred by the seller to increase the value of the property, and that the enhancement can be, is reflected in the state of the asset, which can be seen as a tangible investment. So, for example, somebody might upgrade the windows in a property to triple glazed windows. You might improve the insulation, might build an extension. So capital improvements are generally enhancement expenditure, can also be deducted from the sale proceeds to come to your final tax liability. So transactions not at arm's length. So sometimes people are surprised, particularly in terms of a gift of property through the generations, that, if I'm not receiving, if I'm making a gift to somebody, to my children, and I'm not receiving any cash in exchange for the gift of property, well, in the eyes of the revenue, you're deemed to receive a sum equal to the market value of that property. So even though no cash might change hands, there could still well be a capital gain liability. So it's just one to watch. Sometimes people forget that, even a gift of land to a connected party, you're deemed as if you receive a cash sum equal to the market value of that property. So indexation then. So when the seller receives the sum for the sale of the property, you're entitled to deduct whatever the cost of the property was when you acquired it, and you're also entitled to take into account inflation. So there's a table available with the CGT multiplier. So I've just given a quick example there. So if somebody acquired a property for £100 in 74, and they sell that property today, we're entitled to deduct the cost of that property in 1974. So we're entitled to adjust the £100. So firstly, we'll adjust it to take into account the euro. So it's £100 is equal to 127 euros. But we're also entitled to multiply the 127 euros by 7.528, which is the multiplier for 1974, 1975, which increases the base cost that we're allowed to deduct for CGT purposes from £100 or 127 euros to 956 euros. So you can adjust for inflation for every year up until 2002. So any property purchased after 2002, you're not entitled to adjust for inflation. And the older the property is, the more you can, the higher the multiplier. So, and any property acquired pre-April 1974 is deemed to be acquired in April 1974. So the highest multiplier is 7.528. So it's often surprising how you can increase the base cost of an asset, especially if it was acquired in the late 70s or early 80s. So the annual exemption, so the first 1,270 euros of any gain arising in a year is exempt for every individual. Transfers between spouses are exempt from CGT. They don't give rise to CGT. Quite a common relief that's available is principal private residence relief. So where somebody disposes of their principal private residence, to the extent that they lived in that property for the entire period that they owned that property, the entire gain is exempt. And if they only lived in the property for part of the time that they owned the property, well, relief will be granted for that part of the that percentage of time that they lived in the property as their principal private residence. So quite a common relief and can be quite valuable. And the 7-year CGT exemption, section 604A, so to encourage the purchase of property back in just after the crash, they brought in, the government brought in this 7-year CGT exemption. So any property purchased between 7th of December 11 and the end of 2014, that is a full relief from any gains was allowed for a period of 7 years. So as you can see, that 7 years is almost up now. So we might expect to see some properties, this relief being claimed, hopefully this year. So basically, any gain arising between the date of the acquisition of the property and the date of sale of the property within 7 years, so long as the property was purchased within the relevant time, is completely free from CGT. And that relief applies to land and buildings in Ireland and in the European Economic Area. So site to a child relief, another common relief, applies on the transfers of sites from parents to children, to their children. The site cannot be worth more than 500,000. And if the child does not build a house and live in it for 3 years and subsequently disposes of the property, well, the relief that the parent would have been granted on the transfer to the child is clawed back and becomes payable by the child. So it's aimed at children who actually will, you know, live in the property as their principal private residence. So retirement relief. So I suppose retirement relief in the context of property, retirement relief applies to chargeable business assets, which would include the property within which a business is carried on, so farmland, warehouses, factories. So the relief applies where an individual reaches the age of 55 and they own qualifying assets, which, as I said, would include property, farmland and other types of property used for the purpose of the business. So long as the person owned the property for 10 years and the property was used for the purpose of the business, well, then that person can sell that property, and to the extent that the proceeds do not exceed 750,000, the gain is exempt from tax. Where the person attains the age of 66 years of age, that 750,000 euro threshold is reduced to 500,000. We'll come to that there again in a minute. So that's just the definition of a chargeable business asset. So it's an asset used for the purpose of a trade carried on by an individual or the individual's company. So that's important in terms of property, because we'll see in a minute that we'll see in a minute why. So just a family company. So if you have if one of your clients wants to sell their business property and they're trading through a company, well, it doesn't automatically mean that they'll get retirement relief. The company must be a family company, which means that the person themselves must have at least 25% of the voting rights or 10% of the voting rights, and an aggregate of 75% or more if you take into account other family members who are shareholders. So not all companies are family companies. So that's just, it's not just an automatic relief. It must be a family company. That slide isn't really that relevant here. So when we're talking about companies, in order to claim the relief, the individual must be a working director of the company. So which means that they must work for the company for 10 years and they must work as a full-time working director for 5 of the 10 years. So assets owned by an individual but used by a company. So it's often the case where you have a limited company would operate its business through a property that's owned by an individual. And if that property is sold, to the extent that it's sold at the same time and to the same person as the shares in the company, well, then retirement relief will be available. So revised entrepreneurs relief. So entrepreneur relief, so if somebody doesn't qualify for retirement relief because of age, or perhaps they haven't owned the assets for long enough, they may qualify for revised entrepreneurs relief. Again, business property would include buildings, farmland. So with revised entrepreneurs relief, the CGT rate is reduced from 33% to 10%, and it's restricted to €1 million in gains. It does not, however, apply where assets are owned. So assets in this case typically might be a building used by an individual and used by a limited company. So there's the definition of a chargeable business asset, again, in the context of revised entrepreneurs relief. So it includes goodwill, and it includes ordinary shares in a company. So to qualify for an entrepreneur relief, the individual must own the chargeable business assets for a period of 3 of the last 5 years prior to disposal. So any three years in the 5 years prior to the disposal. So I suppose somebody could buy a building, trade in it for 4 years, and then sell it and claim entrepreneurs relief on it. And instead of paying 33% on the gain on the building, they're paying 10%. So a qualifying business, so the business that the property is used for must be a qualifying business, which would not include investment type business, the holding of development land, or the developing or letting of land. So it's strictly to sort of trading businesses. So on to capital acquisitions tax then. So capital acquisitions tax, where somebody receives a gift or an inheritance, revenue will come looking for capital acquisitions tax. The rate is 33%. There are tax-free limits called groups. So Group A, B, and C. Group A relates to transfers of gifts or of assets from parents to children, and currently the limit is 335,000. So aggregation also applies. So if somebody receives an inheritance in 2021 from a parent, you must take into account all prior gifts or inheritances received from either parent since the 5th of December 1991. So that's aggregation. So that 335,000 euros, you must deduct any prior gifts since 91, prior gifts or inheritance since 1991, to see how much of that threshold remains. So Group B then applies to lineal descendants, so brothers, sisters, so gifts from brothers, gifts from brother to brother, sister to brother, from aunt to niece, from grandparent to grandchild, and also from child to parent. So again, aggregation applies there, so that's 32,500. And Group C then applies to strangers in blood, 16,250. So they're the group thresholds, the tax-free thresholds. So one of the main reliefs that that we deal with in practice is agricultural relief. So agricultural relief, how it works is you take the market value of the farm. Let's say it's $1.5 million. And for tax purposes then, if the beneficiary qualifies for agricultural relief, instead of being assessed for capital acquisitions tax purposes on a benefit, a gift or an inheritance of worth $1.5 million, they're assessed on a gift or inheritance worth 1,500 or 150,000. So in order to qualify for the relief, that person's assets on the date that they receive the asset must comprise at least 80% agricultural assets. So often that would require some tax planning in order to achieve that. And often it gives where a person receives a small parcel of land. Often it's harder to pass the asset test because that person's non-agricultural assets, so their house and car and savings and that, could often be a higher percentage compared to the land or the agricultural assets they're receiving. So funnily enough, if somebody receives €3 million worth of agricultural assets, it's often easier for them to pass the asset test than if they're receiving €150,000 worth of agricultural assets. So if that person passes the asset test, then we're entitled to reduce the taxable value of the agricultural lands to 10%, as I said. And since about 2015, the active farmer requirements were introduced. So the person who receives the land must either A, farm the land themselves for a period of 6 years, or they must lease the land to an active farmer for a period of 6 years. Otherwise, the relief is clawed back. And finally, then business relief. Business relief is a relief that allows us to reduce the taxable value of relevant business property to 10% of its market value. So business relief may apply to agricultural property. There is no asset test when it comes to business relief. So sometimes when somebody, in certain circumstances, if a beneficiary isn't entitled to agricultural relief, they may be entitled to business relief. Business relief only applies to will only apply where all of the assets of the business transfer. So individual assets of a business transferring does not qualify for business relief. So I suppose in the context of a farm, if somebody inherited land, stock, machinery, single farm payments, or if they were inheriting, I don't know, maybe a car sales business, they might inherit the stock, the premises, and debtors. So if all the assets of the business transfer, well, then business relief may be available, and instead of being assessed for the full market value of the business, the beneficiary is only assessed for 10% of its market value. Finally, one relief that I forgot to put in a slide, but it is quite important, the dwelling house exemption. So the dwelling house exemption, previously the dwelling house exemption, basically it was completely taken advantage of because people were purchasing properties, particularly in Dublin, for, let's say, €1 million, and they'd put their son or daughter into the house for 3 years, and then they were entitled to transfer the property to the son or daughter tax-free. Since 2016, it has been severely restricted. So dwelling house exemption is only available in the context of a gift, where it is a gift to a dependent relative. And in the context of an inheritance, the dwelling house exemption will only be available if the person receiving the dwelling house has actually lived in the dwelling house with the disponer for a period of 3 years up to the date of death, and the beneficiary then must remain in the property for a period of 5 years thereafter. So it's dwelling house exemption is not as valuable as it once was, but it does sometimes still apply. So that's my presentation, and my contact details are there if anyone has any questions, and I leave it at that. Thank you.
Thanks very much. Really appreciate that. Just one thing, just given that we had just gotten done with Kat, before I go to the questions that we get coming in, and I'd like to just encourage everybody to come back on that. I'm just trying to going back over my own accounting days, isn't there an annual exemption on CAT?
There is.
And is
Yeah.
that covered? Do you have to count that as part of when you're netting it all or aggregating it all?
There's a small gift exemption of €3,000 per year. So, and it only applies to gifts. It doesn't apply to inheritances. So, so yeah. So I mean, if you don't have to, so any significant gift, and when I say significant gift, I mean a gift over €3,000, must be aggregated.
Okay. Brilliant.
So, strictly speaking, anything over €3,000 a year must be aggregated.
Okay. Well, I've got some questions. I think we've got some on CAT, VAT, and CGT. I might just start with a CGT question then. First part of it, and maybe we take it even wider then, is about working from home, and whether that impacts on your principal private residence status for CGT purposes. But maybe to take the question further, technically, does it impact on perhaps council rates and other aspects of what you should be having to pay? Is there any other?
Well, I don't know about working from home. To be honest, working from home is as we all know, is a sort of a new phenomenon. But certainly, if you were conducting a trade from your principal private residence, so if you had an office in your house, yes, that would impact on PPR relief. I mean, I suppose you would probably do it by way of square foot. You wouldn't be entitled to claim PPR relief to the extent that that part of your property was used in a trade, for the purpose of a trade. The fact that you work from home, I'm working from home right now at the moment. I suppose I really don't know at this stage. It hasn't really been raised. If I was to guess, I don't think it would, because ultimately I still have an employer, and my employment, I'm basically just using the house as a desk, as opposed to carrying on a trade primarily from my house. So let's say if I had a limited company and the registered address was my principal private residence, I think that's different from a person who was just working at home from an employer. But it hasn't been addressed. The revenue haven't addressed it, so I suppose it's something that we'll have to keep an eye on. But certainly, if you conduct a trade from your house, it will impact on PPR relief.
Yeah, well, that's great. Just stick with the CGT vein for 1 second. If the question here is, are there any current or impending property reliefs on the cards, such as the CGT relief up to 31st of December 2014? So I assume that's a kind of what you see on the cards, or what needs to be.
Oh, well, I suppose, what do I see on the cards? Yeah. Well, I suppose very little, to be honest. I mean, if you go back to 2011, there was nobody was buying property, and now everybody wants to buy property, but either the bank won't lend because of the mortgage rules, and builders won't. So the demand is already there. There was no demand for property in 2011, so that's why that 7-year exemption was brought in. There's a huge demand for property now, so I don't see any incentives for. There's no requirement to bring in incentives for the purchase of property at the moment. The requirement now is to incentivize builders, but I don't see any reliefs on the cards for the consumer, to be honest. So no, and I suppose similarly with mortgage interest relief, that was phased out, and that was brought in. I'm not sure exactly when that was brought in. It was brought in way back in the early 90s, I would say, again to encourage the purchase of property. But that was phased out, and I don't see it being brought back in because there's no need to incentivize the purchase of property, because the market is already there. It's on the supply side that the tax incentives are required, as far as I can see it.
Yeah, I would have thought that the change they preferred the stick more than the carrot these days, and the stick is usually being applied in the commercial sector in particular. So in terms of bringing these stamp duty changes around the four or more purchases, etc. And maybe
Yeah.
just, I mean, like on that, or sorry, on the 10 or more, what is the advice that you're seeing in terms of, let's say, landlords who are getting involved in this space, in terms of if members are advising people who are renting properties or becoming accidental landlords, what they need to be aware of?
Well, I suppose being a landlord, it really, I mean, it depends. I mean, the problem with being a landlord is, as far as I can see it, is you get a bad tenant and you're in big trouble, because the tenant has, you know, has extensive rights. So if you get a bad tenant and you're a landlord and you have, okay, you're entitled to deduct 100% of the mortgage interest. So if you borrow to buy a property, you can deduct 100% of the mortgage interest, your income tax liability. But if you're up there, your rental profit is taxable at the higher rate. And then you get a bad tenant who doesn't pay, and you still have to pay the mortgage. But then on the other hand, rents are very, very high at the moment. So I suppose what advice do you give to a landlord? Well, I suppose it really depends on I don't think people are buying buy-to-let properties as much as they were. I don't hear so much about them. But yeah, I'm not sure if that answers your question. I think that the stamp duty relief, that was the stamp duty, the 10% stamp duty rate is specifically aimed at funds, and you know, so really, I don't really advise funds as such. But I mean, I don't know anybody. I've never been asked to advise on anybody who intends to purchase 10 properties or more in a year. But anyway, just on that, I think it's too little, too late. I mean, the government encouraged all these investors through real estate investment trusts. They encouraged all this back 10 years ago. So I think that 10% stamp duty rate is too little, too late. And I can't really see it having a drastic effect. I think I suppose it probably doesn't really matter for the purpose of this presentation. But yeah, landlords, they're getting good rents, but they're not very well protected. Their tenant has a lot of rights.
Yeah. Well, maybe I'll switch over to a cat question then. So I think we've got kind of a scenario here. So pen and paper time. If a child is given a site with a value of 400,000 from a parent, do they have a cat liability as a member of a group?
No.
As a member of Group A.
Oh, the site, yeah, they would, yeah. See, the site, yeah, they would. The site to a child relief, that only applies to capital gains tax.
Yeah.
So the parent won't pay capital gains tax. So if that site is worth 400 grand, the parent won't pay capital gains tax, to the extent that it's less than 500,000, which it is, and it's less than 1 acre. But it will eat into the child's 335,000 euros. So in that scenario, the child will have 22,000 odds of a CAT liability or thereabouts. Yeah.
No.
So it's site to a child relief. It only applies to capital gains tax. It doesn't apply to capital acquisitions tax.
Okay. Excellent. And I think here's a similar one. Let me just see. Let me try to do it justice. If you receive a site from a parent valued at 200,000, so similar enough, build a house to live in, can you still get your 330 tax-free, or is the 200 deducted from this?
It's the same question. No, the 200 comes off.
So the fact that there's a building on it has no there's no difference.
Well, when the site, like before you build your house, the site will be transferred as a green field to the child.
Yeah.
And that's the gift. The gift is of the green field, and if that, so I'm not sure is so usually what would happen is, I mean,
Yeah.
I've never seen a site transfer to a child worth 400,000, but often, so if somebody's coming in and they might be inheriting, if they might be getting a farm from their parents,
Yeah.
often they would have got a site back when they were in their early 20s, and the site might have been worth 40 or 50,000 at the time. So we would deduct that from the 335,000 euros, and then look to claim agri-relief. That's typically the scenario that I would see.
What would be this? What's the best scenario for, let's say, an individual was trying to provide funds to their child to buy a house or something like that? Should they be selling the property directly, or should they transfer the property before sale?
Well, I suppose it doesn't really matter, because, you know, if you take it that so I suppose what you're asking me is if a parent wants to purchase a property for their child,
Or give
do
them
they purchase the property and gift it to the child, or do they give the child the money and let the child purchase the property? Is that kind of?
I was thinking more of an agricultural land, you know, the sale of a field or something. Should it be done?
Well, I suppose with agricultural land, there's a very valuable mechanism called Section 89. It's Section 89.3 gift. So a parent could, or any person could, let's say a parent could gift, for example, €1 million in cash to one of their children, on condition that the cash is invested in agricultural property within 2 years. And to the extent that the cash is invested in agricultural property within the 2 years, the child is assessed not on €1 million, but 100 grand. The child can claim agricultural relief. So on the cash. So to get agricultural relief, I suppose the child doesn't necessarily have to receive, or the beneficiary, whoever that is, doesn't necessarily have to receive agricultural property. So the beneficiary could receive cash from their parents to purchase agricultural property from somebody else. So it really depends on the circumstances.
Okay.
But I suppose if the question is, well, do you buy the field for your child, or do you give the child the money to buy the field? Well, it doesn't really matter, because the child can claim agricultural relief on the cash.
Yeah.
Subject to a Section 893 contract.
Great. I'm going to stick with this theme just and play out another question. That this is probably more to do with a forestry element that I haven't dealt with before. So if a landowner sells a farm with a portion of the property being under commercial forestry, is the sale price of the land and the forestry exempt from CGT, or is it the proportion of the price attributed to the value of the standing forestry?
Okay, so let me think now. So basically, the sale of trees, the sale of standing trees is exempt from CGT. There's a complete exemption. Or a gift of forestry. The disposal of forestry, the standing trees is exempt. So what I have done in the past is I got the valuer to value the standing trees and value the underlying land. Now, the thing about the underlying land with forestry is that it's worth very little. After it's been planted, it's no good. So it usually has quite a low value. So off the top of my head, if I remember, I got forestry valued at €5,000 per acre, I think it was, and like the underlying land was valued at €500 per acre. So I got it broken down: 4,500 for the standing trees and 500 for the underlying land. The underlying land, the transfer of the underlying land, there is no exemption as such, but it's worth so little that it's unlikely to give rise to a capital gains tax liability. It was probably worth more before it was planted. So that's how I look at it. That's how I deal with it. And the sale of the standing trees, well, there's a statutory exemption. So that's how I would deal with that. You apportion the value, the majority of the value, into the standing timber.
Great.
which is exempt from CGT.
And with what we're seeing with construction costs at the moment, timber is probably better than putting your money in the bank.
Well, as well as that, I mean, usually, as well as that, like forestry is brilliant. With forestry, if you inherit forestry or if you receive a gift of forestry, you actually don't have to pass the 80% asset test. You don't have to pass that 80% asset test when it comes to forestry. And as well as that, you can if you receive forestry as a gift or inheritance, you can sell the trees and you don't have to reinvest the proceeds. So it's a great way of passing wealth as well. And of course, the cost of building materials has gone through the roof as well. So
okay, that's great. Let's go in terms of we have one question here on more on the commercial side. If one sells a small rural office building where the owner has delisted from rates, the new owner wishes to convert to residential, does the new owner pay the 7.5 stamp or the 1% stamp? Vendor is obtaining an LPT and vendor is obtaining an LPT number. What that aspect means?
I don't know. So the person already owns the property.
Well, yeah, this is what I guess it depends on when. I assume it's when the incidents. So they've delisted.
But the person, I suppose, the stamp duty arises. Now, look, I'm not sure. I'm not sure about that. But I mean, stamp duty only arises where you have a document that needs to be stamped, right? So that would be a deed of transfer, okay, or release. So when the person delists from a rateable property, a commercial property, to a residential property, I'm not exactly sure what document needs to be. I'm not sure exactly where stamp duty arises. Now, maybe I'm maybe I don't understand.
Yeah, I guess to me, if I'm reading this question correctly, and I'd welcome if you want to come back in and adding this, but it would be: is the vendor converting it from a residential to from commercial to residential? And then it's being sold on, and the transaction is for a residential property.
Oh, sorry, I see it there now. I see the question there now. If one sells a small rural office building where the owner has delisted, the new owner wishes to convert to residential. But like, if the new owner has already paid 7.5%.
Yeah,
I would say. Like, I suppose it depends on the characteristics of the office when the owner purchases the property. Yeah. I would say. So if it's a resident, so the property has been sold and the owner is retiring. I'm going to come back to Mr. O'Donovan on that because I'm not quite sure.
Yeah, I mean, my gut is sort of saying that the rates is separate. Like,
I think it's separate as well. I think whatever the office is, the day it's transferred, it's either residential or it's commercial. Whatever it is on that date will dictate the rate of stamp duty.
Yeah.
And by the looks of things, if the vendor is obtaining a local property tax, it looks like it'll be a residential property on the date of the transfer. Therefore, it'll be 1% stamp duty.
Yeah.
So I think that's how I would look at it. Anyway, the solicitor will want to know if the solicitor if the solicitor has a local property tax number on the date of the transfer. Well, then it's 1%.
Yeah. Yeah. It's a timing issue in who's done it. So.
Yeah. That's what I would say. But again, yeah, stamp duty is generally the preserve of solicitors. It's the solicitor that stamps the document more so than, so they refer to your solicitor, I would say.
When in doubt. Okay, brilliant. Sorry, let me just go to this. We did something similar. This person. So maybe we did something similar. We applied for planning permission before the exchange of contracts, and so that was obviously. So I guess again, this is where for our members being aware of the timing of this. So if you understand what the client and what the vendor are doing, you could probably make sure that they sit down with the likes of a tax advisor to what do we call it? Proper tax planning. Isn't that the way that we reduce our liabilities?
Yeah, that's it. Yeah.
So proper tax planning there by making sure that the change occurs at the right time.
Yeah.
So that's great. Thanks for that feedback, John. just then, I know we said you haven't probably done too much, so you see the question I'm about to
On
ask.
the VAT, yeah. No, VAT on property, I didn't have, VAT on property is a bit of a minefield, and I usually handball off any VAT on property queries to our expert in the department. Now I see that query there. If that person just wants to email me, I'll have a look into it. But how is VAT treated on a PRS development where the asset is developed? And what are the implications from a VAT perspective? So sorry, what's a PRS development?
Private rental scheme.
Private rental scheme development.
The problem, yeah, I mean, the problem that, I mean, my understanding of this, and this is where you correct me, is obviously the costs are incurred as that's a very clever system. I come from America, so obviously it happens right at the sale point. But VAT, as you go through the chain, everybody collects VAT along the way, and everybody's vatable. The problem being that when you get to the rental side, you don't charge rent on VAT, and there's no VAT on rent. So if you're the owner in a PRS scheme, you can't actually get that VAT back as such.
So, okay, look, I don't know enough about the private rental scheme to comment, to be honest, but I look into it. If that person wants to email me, I'll definitely look into it and make an inquiry.
Yeah.
I suppose what did happen, again, back in when the crash happened, you would have had people who registered as developers, okay? So they would have been VAT registered. They would have reclaimed VAT on the build costs. As they built the property, they would reclaim back all the VAT on the construction costs, and then they would have come along and there was a crash, so they weren't able to sell the property, so they entered into the rental market. And in that scenario, then revenue brought in legislation that meant that the subsequent sale of those properties were always vatable. So usually, when a property is over 5 years old, it falls out of the VAT net. But in this scenario, specifically because you had so many developers who are now effectively becoming unintentional landlords because there was no market for the properties. And what happened there was every year, a certain 1/20th, I think, of the VAT incurred or the VAT reclaimed by the developer was clawed back by the revenue. So I'd be surprised if there was any with the private rental scheme. As I said, I don't know enough about it, but I'd be surprised if there's a loophole that allows that VAT to escape. But I'll look into it.
Okay, great. Just a question on the commercial side, coming back to that. As a leaseholder, and you have to do works to the building to just bring it back up to scratch. Is that a capital, or is that just through your normal P&L, or is there any deduction particularly?
If you're a leaseholder.
Yeah, so if you leased a building and you have to, make investments to bring, let's say you're passing it back, and before the handover back to the landlord, you have to do some remedial works. That would probably be, from the landlord perspective, be a capital expenditure, but because you're a leaseholder and you don't have it, is it just a normal P&L deductions, or is it actually capitalized?
Well, if you're handing it back, there wouldn't be much point in capitalizing it because they're not going to.
Yeah.
I suppose it would depend again. Like, I mean, what sort of? If you give me an example, like, why would this? I mean.
So if you're in a situation where you've rented a building, let's say for 20 years, the business lease would require you to bring it back to the level.
Oh, yeah.
So you may have let it kind of deteriorate during your time, and then when you get hit with a bill at the end of the 20 years, realistically, that should have probably been capitalized over that subsequent, but you've got a single year of incidence of it, you having to pay it.
Yeah, well, look, I mean, I suppose it's not something I've seen, but I would imagine you would have to deduct it somewhere.
Yeah.
You would be entitled to deduct it somewhere if you were handing back a leasehold. it possibly could be an extension of, you might capitalize it and just extend it, maybe. I'm not quite sure. Sorry, no, I'm not quite sure.
Yeah, no, that's fine. And maybe just to wrap up, are there any final, like, kind of either things that you'd kind of give, tips that you'd give to the likes of you know, people who are buying new residential properties in terms of you know, tax opportunities, or particularly maybe members who are watching who may be thinking about getting to a period of retirement and doing proper tax retirement for their own businesses?
Well, I suppose that's a whole, right. Well, I suppose when it comes to residential property and renting of residential property, at the moment you can deduct 100% of the mortgage interest, which wasn't always the case. So that's quite attractive in the market, as the market being the way it is, you know, on the basis that you get the right tenant. But property prices are gone through the roof. I mean, I was talking to a guy there yesterday or the day before who sold a property in Longford for 300,000 euros. He got a gift of the property from his father 2 years ago, and it was valued at 120 grand. And the auctioneer said if it made 150, he'd be lucky. And that was in 2018, 2 or 3 years ago. It sold for 300,000 this week.
Yeah.
So it's very hard to advise on anything to do with property at the moment, in terms of, you know, like, should you buy, should you sell, you know, what way is it going to go? In terms of retirement planning, people retiring out of business, I spoke about retirement relief earlier on. That's massive. I mean, retirement, you can avail of retirement relief on the buyback of shares. So if somebody has a company, you can liquidate the company and claim retirement relief on the proceeds of the liquidation. You can also claim entrepreneurs relief, which is a 10%. So I mean, I have a company there, there's €1 million in the company, and we're going to liquidate that company, and the shareholders are going to pay 50 grand each tax, and they're going to take 450 each homes. There's a husband and wife involved, 50-50 shareholder. So those are the sort of opportunities that are there. I suppose what's with tax, and especially when you're talking about retirement planning and succession planning, it's to get in early in the day, to get in a couple of years before you actually pull the trigger. That's important. I just see there's one question there from Mr. Quinn in relation to the 7-year CGT relief. Do you lose 1/7 of relief each year? No, the way it works is if you sell the property, say if you hold a property for 10 years, well then 7/10 of the gain. So if the gain is 100 grand, well then 700,000, 70,000 of the gain is exempt, and 30,000 of the gain. So it's 7/10 in that scenario. So if you hold it for 10 years, 3/10 is liable to CGT. So you'd calculate the gain, divide it by 10 and multiply it by 3, and that's your gain in that scenario.
Well, Donal, we're just coming to the end of the time here, and I think we were sort of going like, would there be any questions? But I think when it comes to tax, there's always plenty of questions, and it's trying to get to them. So I really appreciate you bringing all the knowledge and expertise today. It's been great to end with such an expert for this series that we've run over the past 2 weeks. These will be available for members to watch online, so I'm sure you'll get people watching back. We'll make the slides available. I think also I'm going to go out and plant some trees in some nearby fields on the advice that you've given today. It sounds like a real pocket of opportunity there. And I want to just thank all those who were able to attend and join us today. So Donal, thank you so much.
Thank you. And if anybody wants to email me, feel free.
Great. And if you have any questions, just drop us an email at events@scsi.ie and we can pass on any information that you need. Thank you again, and take care. Have a great day.
Thanks. Bye-bye.